Hello, this is Bob Steele. In this lecture, we will talk about Chapter 9. We're going to continue on accounting for receivables. So we're going to value accounts receivable the direct write-off method. So remember that accounts receivable represents the amount of money that is owed to us. We record the accounts receivable at the point in time, generally when we recognize the revenue for the most part. Meaning that if we do something like a service, such as prepare tax returns, and we earn revenue when we complete the tax return, then we complete the tax return, we would record the revenue and send out the invoice. We may mail the invoice out. When that happens, we debit accounts receivable, we credit sales. We recognize the sale when it happened. Now, when we do that, of course, it could end up at some point in the future where we have to realize that some people are not going to pay us even though we did the work. So at some point in the future, if we said, okay, this bill is not going to be paid, then at some point we need to take it out of the accounts receivable because we need to recognize the fact that we're not going to get that money. And so you would think that you would credit accounts receivable, and then you would think the other side would be kind of a reduction of sales, maybe debit sales, you would think, because it's really reversing the sale. The sale never really happened. It's not a legitimate sale if we're not going to get any money for it at the end of the day. But we don't generally reduce sales. What we do instead is we create an expense account at some point in time, the expense account being bad debt expense. So bad debt expenses is the account that we're going to recognize the fact that we recognize revenue at one point, and we're going to recognize the fact that some of that revenue isn't going to be collected, and we're going to have this bad debt expense to record that. So there's two ways to adjust the bad debt expense. We could use the direct write-off method, or we could use the allowance method to deal with bad debt. Now, the direct write-off method would be the one that would come to most of our minds first. That's the simplest method, and it makes good sense in that what we would do under the direct write-off method is when a debt becomes apparent that it will not be paid, we would write it off at that point in time, meaning if a receivable is no longer going to be paid, I'm saying it's not going to happen, what we would do is debit the expense, bad debt expense, and credit the receivable, taking it out of receivables at the point in time in which it becomes determined that we will not be able to receive on that. The problem with that method, though, is that the period in which we write off the expense does not generally match the period in which the revenue was earned, because the revenue may have been earned in the prior year, and we're matching the expense in the current year, and therefore there could be distortion in the matching principle. So what we would really like to have happen would be that we could recognize the expense in the same time period as the revenue was recognized. That would be in accordance to our matching principle, which is the accrual principle. The only way we could do that is to estimate beforehand how much of the debt will be not collectible, and that would be the allowance method. So the allowance method would be a bit more difficult of a method, and it would take into account estimates, because the idea of it, though, would be that we would match the expense to the time period in which the revenue was earned. Now, if bad debts is not a significant number, then the direct write-off method might be the best way to go, because it won't affect decision makings. If, on the other hand, the amount of bad debt is large, then the allowance method might be a better way to go, because it gives a more accurate picture of what is going on. So for the direct write-off method, we have the company determines on January 23 that it cannot collect $520 owed by its customers. So we're going to say, we went through the receivables. We're saying this bad debt, we're not going to collect on this. We need to take it out of the receivable. How do we do that? The receivable has a debit balance. We're going to make it go down by doing the opposite thing to it, which in this case is a credit. And then we have to debit something else. And once again, you would think it's kind of a reduction of sales, because it's a sale that didn't really happen. But we don't debit sales because we never reduce sales for the most part. We make up another account. It's called bad debt expense. Expenses go up, brings down net income at the time period in which we determine that the debt will not be collectible. Notice that the specific customer is noted in the transaction, so we can make the proper entry in the customer account receivable subsidiary ledger. Direct write-off method, receiving a bad debt. On March 11th, Kent was able to make full payment of the amount previously written off. Now, this doesn't usually happen, but we need to be aware that it could. If we said, this guy disappeared and we're not going to get the money, so we wrote off the bad debt, and then all of a sudden he walks in the door and pays us after we wrote off the bad debt, then we'd have to do two steps to really make our paper trail correct. One, we'd have to put the receivable back on the books by debiting the receivable and crediting the bad debt expense. This is reversing the fact that we wrote off the debt in the past, and then we can debit the normal transaction, meaning debit cash, putting it back on the books, and credit accounts receivable, taking it back off the books. Now, you might be saying, well, why would I do that? Why don't I just debit cash and credit bad debt? Why am I taking it in and then out of accounts receivable here? And the reason for that is basically we want our records to show that he's a good client and it was back on, we put it back on the books. So the reason we have to do this first journal entry is because we're putting the records back in good standing, that it's a collectible debt, and then we collected on it. If we kind of take the shortcut, which would end up in the same result journal entry wise, but it wouldn't give us the paper trail of just debiting cash and crediting the bad debt, then our subsidiary ledger for the receivable wouldn't be correct, in that we wouldn't show that it got paid off. It would look like we wrote it off. So that's why we got to put it back on the books and then take it off again. So matching the two methods, the matching expense recognition principle requires expenses to be reported in the same accounting period as the sales they helped to produce. So that's the problem with the direct write-off method. Again, it's easy. It has no estimates, whereas the allowance method, you have to use estimates, and that causes its own confusion. But it does not adhere to the matching principle, which is a principle that's given to help us to compare financial statements over time. So in order to adhere to the matching principle, we could use the allowance method. So once again, if the direct write-off method could be used if the allowance was not significant, even in a publicly traded company, because that would mean that it would not have influence on decision making in the financial statements. On the other hand, GAAP for publicly traded companies would require the allowance method if the receivables and the write-off from the receivables is a significant number.